this lecture we look at growth investing. And in previous classes we've looked at the benefit of value investing, and when talking about value investing we've discussed value and growth investing as being opposite ends of a continuum. So it's important to note that if there is strong evidence that on average passive value portfolios outperform passive growth portfolios, why is it that there might still be some merit in growth investors, and indeed why is it that there are so many growth funds that exist across the Australian market and indeed across international markets? Well, first of all, it's important to note that what growth investing is actually all about. Growth investors buy companies where they believe that the value of the growth potential of that firm is being underestimated by other investors. So, as a growth investor, you believe that your competitive advantage lies in being able to identify and estimate the value of growth assets relative to other people in the market. So if you're better able to price growth options within a firm, you might be able to get a better measure of the true fundamental value of growth firms and hence identify those particular ones that are either over or underpriced. Now, despite the evidence reported in previous lectures that passive value funds do outperform passive growth funds, there may still be some merit in growth investing. So let's look at the possible justifications for investing in growth. First of all, Damodar in 1994 shows that while passive value investors outperform passive growth investors, there may be merit in growth investing if you're an active investor. And the best evidence of that comes from the fact that on average, active growth investors actually tend to outperform passive growth indexes, whereas on average active value investors underperform passive value indexes. So what does this mean? It means that while on average growth stocks underperform, there may be a greater ability to identify underpriced stocks within the growth space compared with the ability to identify underpriced stocks within the value space. Hence, as an active investor, there might be a justification for investing in growth. Another potential justification for investing in growth is the idea that while on average value outperforms growth, value does not outperform growth in every single period. And in fact, the periods where growth outperforms tend to be those where which are predictable. So that there tends to be some ability to identify those periods that growth is going to do well. And in particular, growth tends to outperform when the yield curve is downward sloping. So what we have on the screen here is the blue line shows the relative interest rates of Treasury bonds versus Treasury bills, or the difference between long-term and short-term interest rates throughout time. Okay. And we can see that the red line is the average return of growth portfolios less value portfolios. Now, on average, the red line is negative. If we took the average across the whole red, that's because on average growth does less well than value. But there are some periods where we see some spikes in this red where growth is outperforming value, and invariably those spikes correspond with periods where the blue line is quite negative, the blue which implies the yield curve is downward sloping. So again, getting back to this idea that there might be merit in growth investing for active investors, if you're a market timer, then there may be some benefit in shifting into growth stocks in periods where you've got downward sloping yield curves, which is implying periods where you think maybe the economy is about to contract in the near future. Because when you have significant drawdowns in the economy, those drawdowns tend to affect the value stocks because those cheaper, more neglected, potentially lower quality names, they are often more highly affected by financial crises. So this is the second reason why there might be merit in growth, incorporating it as part of market timing. A third reason to invest in growth relates to alternative preferences of investors, and in particular looking at skewness. So Zhang 2011 reports that looking at growth versus value stocks, there is actually differences in the skewness characteristics of these different stocks. And what Zhang finds is that on average, growth stocks tend to generate positive skewness, whereas the adjusted skewness, the market adjusted skewness of value stocks tend to be negative. Therefore, comparing value and growth, the zero investment value portfolio of going long in value stocks and shorting growth stocks tends to be negatively skewed. So if you're an investor with skewness preferences, if you're getting utility out of positive skewness, you might be willing to accept the slightly lower average return generated by a growth stock because you're getting this positive skewness, whereas you might be averse to the negative adjusted skewness of value stocks. So given we've now built up an argument that there may be some merit in growth investing, we're going to look at different types of growth investors and different ways that an investor can adopt this particular approach or this particular philosophy. Three different approaches are small cap investor. So the simplest form of growth investing is basically just buying small companies. These small companies are expected to be high growth companies, and you expect that the market might underestimate the value of growth within these firms, so there may be some belief that small firms outperform big firms. Another way of looking at growth is thinking about IPOs. So an initial public offering is where a firm first accesses public equity or first lists on a stock market. The idea here is that if a firm is listing on the stock market, they're sourcing a whole lot of additional capital, and generally that's to fund some form of growth. So this is an indicator of a firm with strong growth prospects, and potentially investing in an IPO might be a way to generate abnormal returns. And last of all, we're going to look at looking at passive growth screens. And what's important to note here is that the screens used by growth screeners are not simply just the inverse of the screens used by value screeners. What growth screeners tend to use are measures of growth at a reasonable price. So measures where they're trying to identify firms with strong growth prospects, yet whereby you don't have to pay a whole lot for that growth in terms of the market price of the firm.